If you have been watching the financial news lately, it feels like the wheels are falling off the bus. Brent crude is screaming past $106, the S&P 500 is down nearly 9% for the year, and every talking head on the major networks is screaming about a growth scare. But here is what Wall Street isn't telling you: they are currently buying the very dip they are telling you to fear. While the headlines focus on the panic, the actual institutional data shows a massive, calculated flight to quality. We are entering April 2026 at a critical inflection point. This isn't a market crash, it is a violent, necessary sector rotation. The easy money of 2025 is officially gone, and the smart money is moving into the companies that actually own the physical molecules and the infrastructure of the future. The narrative being sold to retail investors right now is one of stagflation and despair, but behind the scenes, the big banks are tracking a rolling recovery. They know that the inflationary floor created by triple-digit oil prices isn't just a tax on the consumer, it's a massive profit engine for a very specific group of stocks. Wall Street wants you to stay distracted by the red candles in your tech portfolio so they can accumulate these real asset positions at a discount. They are quietly building a no-landing portfolio, betting that growth will stay high even if inflation remains sticky. Take a look at the first stock on our list, EOG Resources. While the average investor sees high oil as a threat to their cost of living, EOG sees it as a license to print money. This company is a cash flow fortress. They aren't just drilling for the sake of volume, they are operating with a precision that allows them to return 70% of their free cash flow directly to shareholders. In an environment where software companies are struggling to justify their high valuations, EOG is sitting on a massive pile of cash, de-risking their entire operation while the rest of the market panics. This is the structural hedge that the big institutions are using to protect their capital in Q2. The secret that the big firms don't want you to realize is that the AI revolution hasn't failed, it has simply moved into its second, more expensive phase. The market is currently punishing the paper gains of the high-flying software names, but it is rewarding the hard tech providers. This creates a massive divergence. You have these coiled spring opportunities where the fundamentals are actually improving while the stock price is being dragged down by broader market sentiment. As we move through April, you have to stop watching the daily fluctuations and start watching the institutional accumulation zones. The smart money is looking past the immediate volatility toward the end of 2026, where they see a 14% projected gain for the SP. They're using this period of high oil and geopolitical tension to shake out the weak hands. If you are focused on the noise, you are going to miss the signal. The signal is telling us that the 2026 economy is built on energy, infrastructure, and real, tangible earnings. The 10 stocks we are breaking down today are the ones that Wall Street is quietly moving into while they tell the rest of the world to stay on the sidelines. Do not be the liquidity for their exit, be the investor who follows the data. This Q2 pivot is going to define the winners and losers for the rest of the decade, and it starts with understanding that the fear you see on the screen is a calculated tool used by the biggest players in the game. The narrative of the 2026 market is undergoing a massive shift from "what can AI do" to "what does AI actually need to survive?" We have officially moved past the honeymoon phase where a simple press release about a large language model could add $50 billion to a company's market cap overnight. Investors are finally looking under the hood, and they are finding a massive, looming bottleneck in the physical infrastructure. What Wall Street isn't telling you is that the AI bubble isn't popping, it is simply migrating from software into the literal hardware and energy that powers the entire ecosystem. Big Tech has committed over $700 billion in capital expenditures this year alone, and that money is legally and strategically locked in. They are building the AI factories of the future, and the companies providing the bricks, the power, and the memory for those factories are the real winners of Q2. The first major player hitting a massive catalyst in April is Micron Technology. We are currently in the middle of a global high-bandwidth memory crunch. You cannot run a high-level AI server without HBM, and there are only 3 companies on the planet capable of producing it at the required scale. Micron is the domestic leader in this space, and they are currently operating with massive, price-setting power. As data centers transition from the training phase into the inference phase, where these models actually start performing tasks for billions of users, the demand for high-speed memory is going to outpace supply for the foreseeable future. This creates an environment where Micron can dictate margins in a way we haven't seen in the semiconductor space in years. While retail investors are chasing the overbought software names, the smart money is moving into the memory bottleneck. But the physical constraints of the AI revolution don't stop at the circuit board. The biggest surprise for the Q2 market is the massive surge in industrial power and heavy construction. This brings us to Caterpillar. While the average observer views CAT as a simple construction equipment company, the institutional desks are focused on their energy and transportation segment. AI data centers require an unfathomable amount of consistent, 24/7 power, and they need it immediately. Caterpillar's high-output power generators and reciprocating engines are the global gold standard for both backup and primary power in these massive server farms. As hyperscalers like Amazon and Google race to build out their infrastructure, Caterpillar is seeing a backlog of orders that stretches deep into 2027. They are the silent, industrial beneficiary of the tech boom, trading at a much more reasonable valuation than the software giants. If you are looking for the infrastructure play within the cloud itself, look no further than Oracle. For a long time, Oracle was dismissed as a legacy provider, but they have pivoted more successfully than almost any other tech giant of their era. By positioning themselves as the high-performance, cost-effective alternative for AI training, they have captured a massive slice of the sovereign cloud market. In April, as the market searches for growth at a reasonable price, Oracle stands out as a coiled spring. They are showing consistent, double-digit earnings growth driven by cloud infrastructure revenue that carries significantly higher margins than the traditional software licensing. The reality of Q2 2026 is that the cloud war has officially become a power war. It is no longer just about who has the best algorithm, it is about who has the hardware, the memory, and the electricity to run it. The companies that own the supply chain for these resources are the ones that are going to see their valuations explode as the quarterly earnings reports start rolling in. We are moving away from the speculative phase and into the industrialization of AI. If a company is building the foundations, the chips, the power systems, or the data centers themselves, they are in the driver's seat for the next 90 days. While the crowd is still chasing the software names that have already peaked, the institutional rotation is moving into these hard tech assets. This is the hidden backbone of the 2026 economy, and in April, the market is finally going to price that reality in. Most analysts right now are obsessed with debating whether we are heading for a soft landing or a hard landing, but they are missing the most likely reality of 2026, the no landing scenario. This is a market where economic growth stays surprisingly high, but inflation remains sticky and interest rates stay elevated. In this environment, the traditional 60-40 portfolio is dead, and the smart money is aggressively rotating out of paper assets and into physical yield. They are looking for companies that aren't just surviving inflation, but are actually using it as a tailwind to expand their moats. This is where the armor of your portfolio is built for the second quarter. The first major gatekeeper of this capital shift is Blackstone. What Wall Street isn't telling you is that Blackstone has spent the last year quietly becoming the landlord of the AI revolution. While retail investors were gambling on software startups, Blackstone's private credit and infrastructure arms were financing the literal ground these data centers are built on. They currently have a $30 billion data center development pipeline that is nearly 100% pre-leased to the world's largest tech giants on 15-year contracts. They are sitting on a massive war chest of dry powder, waiting for the exact kind of market volatility we're seeing in April to snap up distressed real estate and private assets at a discount. When you own Blackstone, you aren't just betting on a stock, you are betting on the most sophisticated asset managers on the planet to find yield where everyone else sees risk. But defense also means looking at the sectors that are decoupled from the daily noise of the Federal Reserve. This brings us to a massive value play in healthcare, Medtronic. For the last 2 years, Medtronic has been ignored by the market in favor of high multiple tech, but as we enter Q2, it has become a dividend fortress. With nearly 50 consecutive years of dividend increases, Medtronic is a dividend aristocrat currently offering a yield above 3.2%. While the headlines are obsessed with energy prices and geopolitical tension, the demand for Medtronic's surgical robotics and cardiovascular devices remains constant. They are currently trading significantly below their historical fair value, making them a natural magnet for institutional funds looking to hide in high-quality earnings while the rest of the market works through its AI exhaustion phase. If the no landing scenario plays out, the real breakout is going to happen in industrial metals. We are currently facing a structural deficit in copper that is the largest we've seen in years. This is being driven by a triple threat of AI data centers, which require massive amounts of copper for power distribution, a global grid modernization cycle, and a decade of mining underinvestment. This makes companies like Rio Tinto or Southern Copper absolutely essential for Q2. JP Morgan is currently projecting copper prices could hit $12,005. Finally, we have to look at the coiled springs, the giants that Wall Street has been trying to count out, but are quietly building a launchpad for a massive April breakout. While the mainstream narrative is currently obsessed with AI exhaustion and the stagnation of the mega-cap leaders, the institutional desks are looking at the actual data, and what they see is a massive disconnect between price and value. As we enter Q2 2026, two of the biggest names in the tech world are positioning themselves for a second act that the bears completely missed. First, let's talk about Alphabet. For months, the bears claimed that search was dead and that AI agents would cannibalize Google's business model. But the reality of April 2026 is the exact opposite. Alphabet has successfully integrated Gemini 3 into its core products, reaching over 750 million monthly active users, and they have introduced something called agentic commerce. Google isn't just showing you a link anymore. Their AI is now an active transaction engine that helps users complete complex purchases directly within the interface. This has led to a nearly 20% surge in search and advertising revenue at a time when the world thought the sector was cooling. What Wall Street isn't telling you is that Alphabet is currently the cheapest mega-cap tech stock on a price-to-earnings basis. While you're distracted by the headlines, big funds are accumulating Alphabet because they see the 40% annual expansion in Google Cloud, which is on track for a $70 billion revenue run rate. It is a massive growth engine disguised as a legacy value play, and in April, that gap is going to close. Then there is Tesla. This is the ultimate contrarian play for Q2. While the retail crowd is focused on delivery misses and the absence of consumer tax credits, the smart money is looking at the 2026 FSD licensing rumors. Tesla is no longer just a car company, it is an AI and robotics powerhouse that is finally nearing the inflection point for autonomy. With an accelerated robotaxi rollout plan for over 30 US cities this year, analysts like Dan Ives are calling this the biggest growth chapter in the company's history. Tesla is currently trading at a significant discount to its fair value, and the institutional accumulation zones are lighting up. Wall Street is quietly betting on the Cybercab production ramp and the high-margin revenue from FSD licensing that could fundamentally transform Tesla's bottom line by the end of the year. We also have to look at Amazon. While rising oil prices are putting pressure on their retail margins, the real story is the massive expansion in AWS. Amazon is currently investing over $200 billion in capital expenditures this year, primarily in AI and custom chips. AWS growth has accelerated to its fastest pace in years, and the triple-digit growth in their proprietary chip business is a secret weapon that is drastically lowering their operational costs. They are becoming vertically integrated in a way that protects their margins from the very inflation that is hurting their competitors. As we wrap up our Q2 2026 blueprint, the message is clear: stop watching the daily candles and start watching the institutional data. The market is currently punishing speculation, but it is rewarding execution and hard tech infrastructure. To win in April, you have to balance the aggressive growth of the AI backbone with the fortress-like stability of energy and defensive staples. Volatility is not a threat, it is the mechanism that creates the discount. Whether it is the $100 oil tailwinds for the energy sector, the infrastructure necessity of Micron and Caterpillar, or the sheer ecosystem dominance of Alphabet and Amazon, these 10 stocks are the ones positioned to lead the charge. The easy money of 2025 is gone, but the smart money is just getting started. Keep your eyes on the data, stay patient with your entries, and let the macro trends do the heavy lifting for your portfolio this spring.